In today's video, we are going to talk about how to measure the cash value growth in your whole life insurance policy. Now, this question comes up quite a bit by individuals who own a whole life insurance policy. Perhaps you've had one for years and you're trying to figure out, what am I actually earning? Like, what is the cash value actually growing by each year? And then second, by individuals who are interested in taking out a whole life insurance policy, and perhaps you're comparing different life insurance illustrations with different companies because the goal is, how do I maximize the cash value? So we're going to talk about just that today, how to measure the cash value growth on a policy, and let's have some fun with it, shall we? So when it comes to the cash value growth, there are two ways we can measure the actual growth. We can look at the rate, or we can look at it in dollars. Let's look at the rate first, and here's what I'll mention. When you look at terminology in the life insurance industry, it is often described in gross terms. Now, what I mean in gross terms, not that it's a gross product, but what I mean when I say that is the fact that it's gross dollar figures or gross rates. A prime example of this would be the dividend interest rate. So if you have, let's say, $100,000 in cash value, and you have a dividend rate of 6% with a life insurance company. So your cash value balance today, $100,000, you have a 6% dividend interest rate. Naturally, what do you think your cash value will grow by the next year? $6,000, because 6% of $100,000 is $6,000. So will you actually see that? Meaning, if I look at my cash value statement today, I pay nothing in, a dividend rate of 6% is applied to my policy. Next year, will that statement read $106,000? The answer is no. And the reason why is because this dividend interest rate is a gross rate that is applied to your cash value after the company's insurance expenses, mortality charges, everything that comes with the actual life insurance policy. So the net terminology I want to look for here, and what is used in the life insurance industry, is referred to as my IRR, which represents the internal rate of return. And we can look at both the annual internal rate of return and also the average internal rate of return. We're going to go through both as we look at a policy example. But rate, we can look at the actual internal rate of return. And then when it comes to dollars, so we can measure the actual growth based on dollars, which is the same thing, but instead of looking at a percentage, we're going to look at what's the actual dollar amount. So to illustrate this, let's say this is your policy, the $100,000 example, 6% dividend interest rate, but here's what you see. The cash value, the next year, grows to 105. The company told you that you have a 6% dividend, but if I had $100,000, or if you had $100,000, and the next year you paid in nothing and it was worth 105, what did you earn? Well, if we look at the percentage, it'd be $5,000. If I look at it in dollars, that'd be what? $5,000. I said if you look at the percentage, $5,000. What I meant, if you look at the percentage, that'll be 5% over the course of that year. Sometimes I talk too fast and lump it all together because I get excited about this stuff. So with dollars, here's what I want to touch on is in purple. Here we see your money. So your money going into a policy, we always want to take that into account. Meaning when I'm looking at the growth, I'm paying money in, and then also I'm getting money from the insurance company when I look at both the guaranteed rate and also the current dividend interest rate. What's the yearly cash value growth and what's the total gain? Very important item down here. We should not include your money, meaning money you're paying into the policy, as part of the growth. To illustrate that, let's go through an exercise here. So we've got a new policy and then an existing policy. Let's start with the new policy. You start a policy, your day zero, before you pay anything into the product, your cash value is zero because you haven't paid any money in yet. Now, you pay $100,000. We'll assume it's a policy set up for maximum cash value. And at the end of the first year, you've got $90,000 in cash value. How much did the policy grow by that year? Well, this is a pretty simple example, or pretty easy to follow. It did not grow by anything. We lost $10,000. Now let's look at an existing policy, because The worst year of any whole life insurance policy is the first year when it's a new policy. Let's look at a policy and we'll pretend that it's 5 years old. And we'll assume that the year 5 cash value is $425,000. You pay $100,000 again, and now you have $540,000 in cash value. How much did it grow by? Did you experience growth of $115,000 because it was $425,000? Now it's $540,000. So it is true that last year my cash value was $425,000 and now it's $540,000. That's how much? $115,000 in growth. However, remember this point over here? We should not include your money, meaning your payments or your deposits in the overall cash value growth because you paid $100,000. This means the net growth is $15,000 because you got your $100K back. So $425,000 plus $100 brings you to $525,000. And then we've got another $15,000 in gains, which brings you up to $540,000. So really what I want to be aware of is what is the net growth rate or net dollar amount that I'm receiving from the insurance company, whether I'm looking at the guaranteed rate or the present dividend interest rate, and track the actual values as the years pass. Let's look at an example here. So where this can be difficult is with something like this. Here is a full life insurance illustration, a lot of columns. If we take a look at this guy, this is on a 38-year-old female. Here's the funding, annual net outlay, $125,000 in the first year and then $100K per year through year 5. Here's my money column, net cash value end year. Look at this, by year 4, just about $425,000 in cash value. She paid in $100K. Now she's got $540,000, which means she got her $100,000 back plus approximately another $15,000. And then the next year, we paid 0 in, but I see it grew from $540,000 to $564,000, which is growth of approximately $24,000 in this example. Then we've got the death benefit in the far right, but a lot of columns here. So what life insurance companies will often provide, and this is to both agents and policyholders, are additional reports in an effort to simplify things. So if we look at an additional report here, here's the same policy, referred to as an illustration summary, exact same policy from the same illustration. And here's where I think it can be a little bit confusing. This is my opinion. Here's the annual net outlay. There's your payments. Cumulative net outlay tallies up the total payments over time, $525,000. Here's the net cash value, identical to that illustration we just looked at. There's the year 4 cash value, and then there's year 5. But then this column, net annual cash value increase. So the first year, you paid what? $125,000. It's worth $112,000. And when you see this column here, net annual cash value increase, what does it make you think? For me, it makes me think like my money is increasing by that dollar amount. Where in reality here, if I paid $125,000 and I have $112,000 in cash value, I don't care how you slice it, that's about a $12,500 hit, a little bit more in this example. Meaning I lost money. I paid in $125,000 and I did not get the full $125,000 back. The next year, net annual cash value increase. I see $96,716. What this represents, let's isolate this year. So we're looking at year 2, where the illustration summary states I've got a cash value increase of $96,000 and change. So you paid in $100,000. The cash value was $112,000. Now it's $208,000. If this was a 0% bank account and you added $100K to $112,000, what would it be worth the next year? $212,000. But it's not. What's it worth? $208,943, which means you lost money. So here, we paid in $100K. What actually happened, we got $96,716 back. So we lost almost $3,000 in the second year. Early years are the worst part of any whole life insurance policy. We're minimizing that upfront hit but it is still an upfront hit. So finally, the next year, you pay in $100,000, you get that back and some. Here it reads the net cash value increase is 105 and change, and the reason why is because it's taking the year 2 cash value and saying, hey, it was 208 and now it's 314, which comes out to an increase of 105. But the thing is, we have to take into consideration the payment you made to the policy. It's important to do that, because if I'm just adding it to a 0% bank account, then yeah, it's going to grow by $100,000 because I actually put my money in the policy or in the account. So let's take a look at just a quick Excel workbook here. And what we've got is as follows. So exact same policy, just everything broken down in Excel. And we'll go through this one at a time. So we've got year age, annual outlay. There's 125 in the first year, then 100K per year through year 5. Total payments, what's highlighted in yellow, represents the break-even point. Almost year 4, so close. If she gets ultra preferred, this is going to be year 4. But there's our total cash value pulled from the illustration. Then there's our death benefit. Here's the dividend interest rate, 6%. So sometimes I do like to show this column because over the years I've always gotten the question, hey, if I have a dividend of 6%, that's way better than what I'm getting in my bank account. So yeah, I'd love to put the money here. So when I hear that, I just kind of want to say, okay, thanks for mentioning that. So a dividend rate, how that works, have you ever broke down the dividend rate? Have you ever looked at your cash value growth and applied that dividend rate? No, I haven't done that, but it's a dividend, right? 6%. Thanks for mentioning that. So how it works actually is that it is a gross rate that's applied after the insurance expenses and such. And here's a great way to illustrate it. So you see that dividend of 6% in the first year, but you pay in 125, and how much do you have? 112. So you lost money. I don't really care if the dividend's 1,000%. If I lost money, my actual net growth rate, the internal rate of return, will be negative. Which is why, when we look at everything here, the first year annual IRR, we see just over a 10% hit, negative 10.22%. That is in percentage points, how much I lost when I paid in 125 and I have 112 in cash value. The average IRR will be identical to the annual IRR only in the first year. Then as time passes, it's going to take into account all payments and the year that the money is deposited into the policy, and then the total cash value growth. So year 2, I see a negative IRR. Year 3, I paid in 100, I got my 100 back, and some, 1.72% is the net IRR this particular year. The following year, 2.54%. Year 5, 3.06, and look at this. The average IRR is no longer in the red. What you'll see as well is that break-even point, when I see this highlighted in yellow, representing when I have more in cash value than what I've paid in, that's when I'll see that average internal rate of return no longer in the red. But let me show you something here. So that annual IRR, is it easy for you, or anyone for that matter, to say, hey, year 2 I had 208, I paid in 100, I got 314, I can easily calculate that's a 1.72% return. No, it's not that easy to do that for most people, right? There are some people that can do that in their head like that. I cannot. This is why I love Excel and calculators and such, as it's fun. And you can do it with a calculator too. We've got other videos that do that, but we've got some nice tools. So let's look at this, shall we? Let's look at the same IRR, the annual IRR, but in dollars. So what we'll look at here, what does that negative 10.22% come out to? Well, this one's pretty simple. I would just subtract the cash value of 112 and change from my first year payment, and there I go, negative 12,773. That's what a negative 10.22% IRR in cash value is this year. How about the next year? Now what I want to do, subtract the year 2 cash value from the year 1 cash value, and then also subtract it from my payment. And there I go, negative 3284. That's in year 2. Now, year 3, that 1.72% positive IRR. Let's take a look here. Here we go. What that came out to, the net growth that year, 53.17. Let me show you something real quick. Back to this. Look at the net cash value increase here. 105.317. Back to the Excel workbook. Just 553.17. $100,000 difference there. The difference is your payment. Very interesting, right? It's fun with the numbers. It's simple once you go through it a couple times, right? If you've seen this before, then you know, like, hey, Steve, this is like simple stuff. It's all with repetition. But the first time we see it, it's a little eye-opening because we haven't experienced it before. You ever do something for the first time, it takes you 4 hours to complete a project, you're frustrated, and then the next day or a month later, you can do that same project in 4 minutes instead of 4 hours. Just repetition, going through it a couple times. So let's look at the annual cash value all years. And this is consistent with the annual internal rate of return. There we go. Personally, I like to see the dollars, like what's the actual dollar amount I received this year. And then we can look at the total gain as well, which will be consistent with the average internal rate of return. And this will be pretty simple too. So we just want to take whatever the cash value is and subtract it from our total payments. And just like the average internal rate of return, look at this. By year 4, we're 0.02% in the red. That's our average internal rate of return. And the reason why is because we've paid in $425 and we've got $424,800 minus $3. That's why we see that 0.02% negative hit. The next year, the average IRR is almost 1%. Reason why? I paid in $520, got $540. We do need, with the average IRR, we do need to take into account the fact that I made those payments over 5 years. If I pay in $525 in day 1, then that average IRR will be a little bit different there. But here we go, positive by year 5. And then go all the way down, voila. So now we can simply see there's our gross dividend rate, but here's our annual internal rate of return, the net annual growth. There's the average internal rate of return. And then we do the same thing, but in dollars. When this gets really fun is when we take actual policies and track them on a yearly basis and do the exact same thing, or just show one report if you're working with us and say, hey, what's the growth rate I received this year? Or what's the dollar amount I received this year? Or just show me both so I can see them both. Everyone's different. Again, I like the dollars, but there's some people that prefer the rate and some people that like to see both. In any event, I'll keep rambling, so I'm going to stop now. I hope you enjoyed this video. If you did, please let us know. You can leave a comment or any questions below, and feel free to hit the like button, subscribe for more. That does help us. And as always, I hope this helps. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.